If you want to invest in a company's IPO, there are a few things you should consider. These include why the company wants to raise funds, how their business works, what the company is good at, and where they might need improvement, who the people in charge are, and how much the company is worth compared to others in the same industry. We'll talk more about these topics in detail. Hi everyone, welcome to Candle Speaks. If you're new here, make sure to hit that subscribe button and turn on notifications so you don't miss any of my future videos. If you want to apply for an IPO, you have to first open a Demat account. Below I am sharing a link that shows you how to open a Demat account. Watch the video to learn how to do it. If you want to get updates about the market, you can join our Telegram channel using the link provided in the description. Before investing in a company's initial public offering, IPO, it's crucial to find out how they plan to use the money raised from the sale of shares. If the company states that the funds will only be used to repay debts, then it may not be a wise investment option. However, if the company intends to use the funds to repay debts, and also expand its business or invest in general corporate activities, then it indicates that the money will actually benefit the company, which makes it a good investment option for potential investors. Before putting money into a company's initial public offering, IPO, the investor must know what kind of business the company operates. Once they know the company's business, they need to identify new opportunities in the market. This is important because the size of the opportunity and the company's ability to take advantage of it can determine the growth and returns for shareholders. If the investor is not clear about the company's business activities, then it's better to avoid investing in its IPO. Before investing in a company's IPO, the investor should conduct a SWOT analysis of the company. They can find the company's strengths and weaknesses by reviewing its draft red herring prospectus, DRHP. Investors should also determine the company's position in the industry it operates in. It's recommended to gather information about the company and its strategies from different sources, so that investors can evaluate the company's future potential. The people who start a company and own a big part of it are called promoters. They come up with the idea for the company and put in the money to get it started. The managers are the people who run the company and make sure everything is working well. They make important choices about things like spending money, cutting costs, and buying or merging with other companies. Both the promoters and managers are important for the company's success, and people who want to invest in the company should think about both of them. When a company wants to raise funds by selling shares to the public, it files a preliminary document called the Draft Red Herring Prospectus, DRHP, with SEBI. SEBI reviews the DRHP and provides its feedback. Based on the feedback, the company makes necessary changes to the document and files the final version called the Red Herring Prospectus, RHP. The DRHP provides information about the company to potential investors, and it helps them make informed investment decisions. Valuation is the process of determining the worth of a company. It's an essential aspect of investing, because it helps investors understand the company's fair value and make wise investment choices. Different valuation methods are used based on the company's industry, size, growth potential, and other factors. Before investing in an IPO, investors should also check the company's valuations, as the offer price may be undervalued or overvalued, depending on the industry it operates in and its financial ratios. Comparative peers, also known as peer group analysis, is a method used by investors to compare the financial performance of a company with its peers in the same industry. This method is helpful for investors, as it provides insights into how well the company is doing compared to its competitors. It allows investors to identify potential investment opportunities and risks and make informed investment decisions. Investment horizon refers to the length of time an investor plans to hold the shares of a company. Before investing in an IPO, investors should decide if they want to hold the shares for the short term or long term. Short-term investors should focus on preserving capital and generating income, while long-term investors should aim for higher returns through capital appreciation. It's important for investors to have a clear investment horizon before investing in an IPO. The stock market is about choosing the right time to buy and sell stocks. Sometimes it's best to buy stocks when a company goes public, but other times it's better to wait. You should decide based on how much risk you can handle and how strong the company's financial situation is compared to its value. It's important to know that buying stocks during an IPO can be risky, just like the regular stock market. So, before investing in an IPO, you should do your research to make sure it's a good idea. Thank you for watching, and we look forward to discussing more interesting topics related to financial markets in our next video.